Now we will solve another problem, and in this problem we will actually figure out the manufacturing overhead variances. Remember, manufacturing overhead has two types or two parts. One is the variable part, another is the fixed part. So first we will find out the variable manufacturing overhead variances. Conceptually it's just like the direct labor variances, because variable overhead actually is driven either by direct labor hours or by machine hours. So the concept is same. We will use three boxes. First will be all actual, and the third one will be all standard, and the middle one will be the combination of actual and standard. Again, variable overhead is usually driven by labor hours, and we will also use the same concept, variable manufacturing overhead rate variance and variable manufacturing overhead efficiency variance, what we just did in our previous problem for direct labor variances. But the fixed overhead variance will be a little bit different. So let's try to do the variable manufacturing overhead variance, and all information is given here. We will go over this problem thoroughly to know what type of information we actually need. So here you will see that this paragraph is the first paragraph. It's actually talking about all standard information, the standard part, and the second paragraph is talking about the actual information. So let's try to write down our boxes and then we'll read the problem together. First, I'm trying to do the variable manufacturing overhead variance. And again, here for the variable part, it is just like the direct labor variance. So I'm not using the Excel boxes that I used last time. It was a bit inconvenient, but I'll try to show you all these three parts and boxes. So first part, we will use all actual. That means we're gonna use the actual hours times the actual rate. And then for the second part or second box, we will use the actual hour, but we're gonna use the standard rate. And for the third box, we all will use the standard information. That means it will be the standard hours times the standard rate. And now if you check here, the first box versus the second box, the difference is basically because of your rate. In our first box, we are using the actual rate, whereas in our second box we are using the standard rate, and that's why the difference between the first and second box will be known as the variable manufacturing overhead rate variance. Now if you compare the second and the third box, the main difference here is actually hours. In your second box, you are using the actual hours, and in your third box, you are using the standard hour. And for both second and third boxes, we are using the standard rate. So the main difference is the hour, and which actually again determines our efficiency. So we will call these differences as the variable manufacturing overhead efficiency variance. So now let's call it again, the differences between the first and second box is known as variable manufacturing overhead rate variance. And then the second and the third box will be known as the variable manufacturing overhead efficiency variance. And now what we will be doing, we will be actually plugging all these numbers by reading this problem, and then we'll do our calculation. So First, we need to find out what is the actual hours and what is the actual rate. Again, the actual information is actually given here in our last paragraph, and the first paragraph is actually talking about the standard information. So here, this is actually your actual cost, which is calculated by using the actual hour and actual rate. For some problems, you will see that this cost will be given, but for some problem the rates will be given, and for some problem the total actual cost will be given. Here, we will figure it out what type of information we actually have. We are doing the variable part, and the second paragraph is all actual information. And if you read this second paragraph very carefully, it actually doesn't identify what is the variable overhead cost, but it actually says what is the total overhead cost. So the company actually processed 158,000 cases of frozen organic fruits, and they incurred 682,460 of manufacturing overhead costs. So this 682,460 is actually the total manufacturing overhead cost, and of this amount 633,000 was the fixed portion. That means this is our total overhead, and out of this 636 is the fixed portion. That means if you take out 636 from this total overhead part, then you will figure out your actual variable manufacturing overhead. So for this actual part, it's not, the rates and hours are, actual hours are not given, but the information is given in a little bit of different way. That means we need to figure out what is actually the total cost here. So the total overhead cost is actually here, it's given, it is actually 682,460. This is the total overhead. Now if I take out the fixed overhead part, which is 636,000, then you will find out the variable overhead part, and of course this is the actual variable overhead. So this is basically the first box here. Now we will subtract our actual hours times actual rate. That means the second box. Now it's given here that the company incurred a total of 40,400 direct labor hours. So that means this 40,400 is the actual hour, and now we're gonna multiply it with the standard rate. Now we need to read the first paragraph. And it says that Aloha Food processes bags of organic frozen fruits sold at specialty grocery stores, and they actually allocate the overhead based on the direct labor hours, and their budgeted fixed overhead is 626,000. Predetermined fixed manufacturing overhead rate is 16.20 per direct labor hours, while the standard variable manufacturing overhead rate is 70 cents per direct labor hour. Remember, this sentence is talking about standard rate, but one is for the fixed part, which is $16.20, and the other is the variable part. So the standard variable overhead rate is 70 cents. So now we are doing the variable part, so we need that 70 cents, which is the variable manufacturing overhead standard rate and per hour. So now we actually used our actual hours, 40,400. Now we're gonna multiply it by this 70 cents, which is the standard rate for the variable portion. So now if I multiply this, then you will find your second box. Now if you again, for the actual variable overhead cost, we took the total overhead which is given here, and then we subtract the fixed portion, and this is how you're gonna get the actual variable overhead. So if you subtract this, that means 682,460 minus 636,000, you will find 46,460. That's actually your actual variable overhead. Now if you multiply these two components, which is actually our second box, 40,400 times 0.7, what I found, it's 28,280. Now if you take the difference here, this difference is 46,460 minus 28,280. I found it's 18,180. So now we have to check whether it's a favorable one or unfavorable one. So the first box is talking about the actual part. So this is the actual cost, 46,460, and the second part is the standard part, 28,280. Again, all these are costs. So now if you see your actual is higher than the standard part, then it's an unfavorable one. And here we see the first part, which is all actual, which is higher than the standard part, so we'll call unfavorable, and you need to write down this little U next to it. Now we will do our variable overhead efficiency variance. And again, for this part, we're gonna do the difference between the second and the third box. So the second box is actually AH times SR, and the third box is SH times SR. So it's better if I could write it down here again. The boxes, I actually didn't do it here, but I can do it for your convenience. But don't be confused, for this one we actually didn't get the actual variable overhead by using the actual hours times actual rate. Rather, we subtracted our fixed portion from our total actual overhead, and this is how we got this actual variable part. So I'm just writing this formula one more time for you so that you know how I get it here, and I'll do the same thing here. So for this part, we actually need to figure out the difference between box number 2 and box number 3. So if I take box 2, which is AH times SR, and then the box 3, it's SH times SR. I just wrote the formula one more time here so that you understand how I'm getting all these numbers. So now here, AH times SR is already given here. AH times SR, that's the second box. We also used it for our first variance calculations. So AH means our actual hours. It's again given here, 40,400. Standard rate is also given here, which is 70 cents. Now for the last box, we are gonna use all standard parts, standard hours times the standard rate. Remember, we are just doing the variable overhead portion. So for the standard part, we're gonna use only the standard portions. So now standard hour. So let's check here. It says that the standard hour is, for the variable portion, it's the standard hour is actually given here 1/4 of an hour. The direct labor standard for each case is 1/4 of an hour. So this is the standard hour, and it is actually for only 1 unit of products, and they actually did how many units? So they actually processed 158 cases. So this 0.25 hour or quarter hour is for 1 case. The company processed 158 cases, so we need to multiply these two to figure out the total or entire standard hours. So I'm repeating again, the standard hour is 0.25 hour for 1 case, and they actually produced how many cases? They processed 158,000 cases. And this is how you will figure out what is the total standard hour. So these two together will tell you the total standard hour. And then we're going to use the standard rate, which I already know. It is 70 cents. So now we will multiply all these numbers and we'll figure out the results. So for this box, it's already given here. We used it the same numbers here, and we already see the number here. You either can calculate it or just copy it from here. You will get 28,280. And now for this part, the last part, we need to multiply all these three numbers. 0.25, quarter hour for per case. They processed 158,000 cases, and the standard rate for variable part is 70 cents. So if you multiply these three, what I found is it's $27,650. Now we need to find out the difference, and we will call this difference either a variable or a favorable or unfavorable one. So what I did, I take the difference, and when you take the difference, I mentioned it earlier several times, don't worry about the sign. So I found the difference is 630. So don't worry about the sign, take the absolute difference and then check the actual portion. The left side is the actual versus the standard. So you see the actual is the actual information based on the actual hours. The cost based on the actual hours is 28,280, and the all standard is 27,650. So the actual is actually higher than the standard. Since actual is higher, it will be an unfavorable variance. And this is how you can calculate your variable manufacturing overhead variance. Again, I prefer to use these boxes and to show it like this. If you want, you can also use the same thing. Now we're going to calculate the fixed manufacturing overhead variance, and this one is actually a little bit different. So now let's try to calculate it. Fixed manufacturing overhead variance. And here, if you remember, when we discussed the PowerPoint slides, it's actually a little bit different than all other variances that you calculated and you learned today. So again, for fixed portion, we will have three boxes, but the boxes are a little bit different here. Okay, so for your first box, we will show our actual fixed overhead, and then in our second box, we're gonna show budgeted fixed overhead, budgeted fixed overhead, and in our third box, we're gonna show all standard, which will be determined by standard hour times the standard rate. Remember, here now we are talking about the fixed portion of your overhead, and of course for our standard part we'll check what is the standard hour for the fixed portion, what is the standard rate for the fixed portion. So again, the first and second box you have to compare, and the difference between this first and second box is actually known as fixed manufacturing overhead budget variance. So the names are a little bit different. So the difference between here, we will call it fixed manufacturing overhead budget variance. The difference between the first and second box. Now the difference between the second and third box is known as fixed manufacturing overhead volume variance, because that variance is caused because of the differences in the volumes, production volume. So now let's try to calculate the fixed manufacturing overhead budget variance. Again, it's the difference between the first and second box. So I prefer to write down the boxes one more time, and if you write it when you're gonna practice, it will be helpful for you to know all these formulas. So instead of just memorizing it, try to understand all these concepts. So now we will find out the fixed manufacturing overhead budget variance. which is the difference between the actual fixed manufacturing overhead and budgeted fixed manufacturing overhead. So the last paragraph or the second paragraph of this problem is talking about the actual part, and it says that $636,000 is the actual fixed manufacturing overhead. So I'll write it down. It's $636,000. Now, what is the budgeted fixed manufacturing overhead? It is also mentioned here in this problem. It says that Aloha has budgeted fixed manufacturing overhead for the year to be $626,000. So we will take this $626,000. Now, if you take the difference, 636 minus 626, again, don't worry about the sign, just take the difference, which is 10,000. Now try to apply your common sense. This first part is the actual and the second part is the budgeted. And if you see the actual cost is higher than the budgeted one, then it's an unfavorable one. If you see the actual is lower than the budgeted one, then it will be a favorable one. What do we see here? We see the actual fixed overhead is higher. 636 is higher than 626. So since the actual is higher than the budgeted, we're gonna call it as an unfavorable one. Now let's try to do this last variance, which we actually call fixed manufacturing overhead volume variance, and is the difference between box number 2 and 3. So in box 2 we have actually budgeted fixed manufacturing overhead, and in box 3 it is actually all like standard hour times standard rate, and again these are only for your fixed portion. Now the budgeted fixed overhead, which is already given here, 626, we also used it for our first variance here, 626. So I'll write it down here, 626. Now you need to find out this standard hour and standard rate. Remember, it's for the fixed portion. So now standard hour, it's already mentioned here. For one case they need 0.25 hours and they actually processed 158 cases. So this will be the standard hour. Now for the standard rate, it says that the predetermined fixed manufacturing overhead rate is $16.20. So predetermined rate means the standard rate, and this is for the fixed portion. So now first we will find out the standard hour. It's given for one case, the standard hour is 0.25 hours, and they actually produced or processed 158 cases. So this will be their total standard hour. Now we're gonna multiply with this standard rate, which is the standard rate for the fixed overhead portions. So the standard rate is given here, $16.20. Now if you multiply this 3 here, then you will figure it out all based on your standard information. So now I did it. The first portion, it's already given, 626,000. This is actually our budgeted fixed overhead. Now we're gonna use all these 3 parts to get the standard portion. So that means you have to multiply 0.25 times 158,000 times 16.20, and what I found, it's 639,900. So now you have to find out the difference, 626,000 and 639,900. Again, don't worry about the sign. Don't worry about the sign. So just try to use the absolute difference, and then you will apply your common sense, and then we're gonna call it whether it's a favorable one or the unfavorable one. So I found the difference, 626 minus 639,900. Again, don't worry about the sign. I found 13,900. And now you can compare. This one is the budgeted one. It's the flexible budget based on their processed cases, and this is all standard. And you see this all standard is actually higher than this budgeted one, which is based on the flexible budget, so we'll call it as a favorable one. So you have to write down this letter F. Please don't forget to write down this U or F, which means the favorable and unfavorable. And this is how you can calculate your fixed variable overhead variances. And for this one you have two type of variances. One is the fixed manufacturing overhead budget variance, and another is the fixed manufacturing overhead volume variance. Again, I love to use these boxes. These boxes are actually useful and helpful to memorize or to remember all these formulas. So hope you will practice this problem and you will also do